Welcome back. So, if you were watching the markets in that last week of August, you probably felt like you had whiplash, right? Good news, bad news, record highs one day, sharp drops the next. I mean, it felt like everything was happening all at once. So, let's break down what was really going on.
And that's really the big question we're going to dig into. It wasn't just you, the market really was being pulled apart by these powerful conflicting forces. The old stories that had been driving stocks all summer, they suddenly just fractured, and that created a much more confusing and frankly volatile picture for all of us.
The best way to get our heads around this is through what we're calling the market trilemma. Think about it. You have a powerful tailwind from the world's most important central bank. Then, at the exact same time, you get this massive headwind from a geopolitical shockwave. And to top it all off, the market's main engine, that big AI story, it started to sputter. So let's break down each of these forces.
All right, first up, let's talk about the good news. This is what had everyone so optimistic early in the week, the big pivot from the U.S. Federal Reserve. This was that monetary tailwind pushing everything higher.
Now the key here is the language he used. At the big annual meeting in Jackson Hole, Fed Chair Jerome Powell totally changed his tune. By saying the balance of risks appears to be shifting, he was basically signaling that worries about employment were growing. That was the green light the market had been desperately waiting for.
And the reaction? It was immediate. I mean, boom. Traders in the futures market almost instantly priced in an 87% chance of an interest rate cut in September. That wave of pure optimism was powerful enough to push U.S. markets to new all-time highs right in the middle of the week.
But here's the thing, the Fed isn't the only game in town, and we're seeing this growing split in global policy. So while the U.S. is getting ready to cut rates, the Bank of Japan, which is seeing really strong growth, is signaling it's going to keep raising them. This kind of divergence is a huge deal for where money flows around the world.
Okay, but just as the market was popping the champagne for the Fed, a geopolitical shockwave hit out of nowhere. This second force created this powerful headwind that challenged that entire optimistic story.
And that shockwave was a surprise 50% tariff slapped by the U.S. on a whole range of Indian goods. Now, the crucial point here is the reason. This wasn't a typical trade dispute about, steel or something. It was punishment for India buying Russian oil. This was, effectively, the U.S. weaponizing trade policy to achieve its foreign policy goals.
And the fallout? No, it was immediate and it was severe. India's Nifty 50 index became the worst performing major index in the world. The rupee plunged to a record low, and foreign investors just ran for the exits, pulling out the equivalent of over $1.5 billion US, a direct, brutal market reaction.
Okay, so we've got a dovish Fed on one side, a new trade war on the other. But there was a third, equally important force at play, and it came from the market's main growth engine, artificial intelligence.
The big event of the week was earnings from the AI bellwether, NVIDIA, and the numbers were, once again, absolutely stellar. Revenue up 56% from last year, easily blowing past expectations. By all accounts, this should have sent the stock soaring. But it didn't. In fact, the stock sold off sharply on Friday, dropping over 3%. So what happened? I mean, why would the market sell off on such fantastic news? What happened is that the AI story is maturing. It's growing up. We're moving from the left side of the slide to the right side. The era of just buying any stock with AI in the name, that's over. The market is now shifting its focus from pure hype to actual scrutiny. It's demanding not just growth, but a clear path to profits and flawless execution.
So, how do we put all this together? These three forces, a friendly Fed, a new trade war, and a maturing tech cycle, they're all colliding to create a brand new and much more complex market environment for us to navigate.
And you can literally see that collision in the sharp divergence between different regions. The U.S. market ended up flat, caught in a tug-of-war between the Fed's pivot and that tech sell-off. India, as we saw, got hammered by the tariff shock. And then you have China, which actually rallied on hopes of its own domestic stimulus. The world is just not moving in one direction anymore.
And hey, just to add another layer of complexity to all this, investors are now walking into a major historical headwind known as the September effect. This is a really well-documented anomaly that says September is, historically, the stock market's absolute worst month.
And the data really backs this up. I mean, look at this. Since 1950, the S&P 500 has lost an average of 0.7% in September. Meanwhile, it's gained an average of 0.8% in all the other months. That's a pretty significant statistical headwind to be facing.
So, what's the big takeaway from all this? Well, it's that the market landscape has fundamentally changed.
The biggest risks are pretty clear. The Fed could make a mistake by cutting rates right as new tariffs are stoking inflation. Geopolitical tensions could get even worse, and that sell-off in expensive tech stocks, it could spread. The days of simple trend-following strategies are likely over.
And this leaves us with the central conflict, the big question heading into the rest of the year. You've got this powerful tailwind from a Fed that wants to cut rates, and an equally powerful headwind from a new, totally unpredictable trade war. The real question is, which force is going to win?